Hi, I am Pratim Ranjan Bose, and you are watching Podcast with Pratim, presented by Iravati Research and Communication Center, or IRCC. In this episode, we will discuss about the Great Indian Credit Gap. Nearly 80 years since independence, and with access to remarkable digital tools, India has failed to reach affordable credit to its rural population and business. You can just generalize that into the regular mass people, whether urban or rural. The much hyped microcredit is available at 24% or above. NBFCs, that is non-banking financial companies, offer loan to farmer organizations at 17 to 22%. On paper, large banks offer credit at cheaper rates. In reality, very few have access to such credit. In common sense, that is to generate profit after servicing interest of 24%, the business must generate a gross margin of 50% or more. Which small enterprise or farmer can expect such margins, leave alone expect, which can even dream? The question doesn't end there. High credit cost translates into a range of social and economic maladies, from high cost of food, low margin for retailers, farmer suicide, to low consumption and production growth. Everything is ultimately linked to finance. To discuss the issue, I have Prabhat Labh. Prabhat is a development leader with over 25 years of experience of working across Asia, Africa, and North America. He has designed and led microfinance, agriculture, digital finance, and women's economic empowerment initiatives for Grameen Foundation, MasterCard Foundation Canada, CARE, Entrepreneurship Development Institute of India, Axis Bank, etc. Prabhat supported large number of microfinance institutions by handling huge portfolio of funds on behalf of DFID, now FCDO UK, and MasterCard Foundation. He is now establishing an agri-food company that will connect farmers to market. Welcome, Prabhat. Thanks for joining the show.
Thank you, Pratim, and wonderful to be here on this podcast with you. And thanks for also laying out the background to this conversation. So really looking forward to this conversation. Wonderful.
Prabhat, for half a century, all top institutions in the world, from World Bank to Wharton School, promoted microcredit as a tool to bring people out of poverty, quote unquote. Do you really believe in this narrative? Back in the 1990s, when I got my first credit card, I overspent and suffered. I saw people borrowing from one credit card to repay another and ending up in perpetual indebtedness. I saw credit card recovering agents coming, abusing clients, and extracting their pound of flesh. I also saw people creating ruckus to escape repayment of high-cost debt. In some ways, I find a similarity with microcredit operations. People are borrowing from multiple lenders. Same set of women fronted by men are borrowing in repeated cycles. I see people awaiting political intervention to escape the repayment. It happened in various parts of the country, from Andhra Pradesh to Assam. I would like to know why microcredit in its present form is different from private money lending. Don't you think it is time to review and redesign this activity with an eye to offer cheaper loans? Over to you.
Thank you, Pradeep. And that's a great question. And especially as I look back at my own journey in microcredit, microfinance for over 20 years in India. And in early times, I was supporting programs to help support small grassroots, nascent NGO microfinance institutions, which were just getting started in the world of microcredit. And if I remember the kind of things we were really concerned about at that time, it was about the desire to help people come out of poverty. It was a desire to empower women, organizing them into self-help groups and all of that. But also realizing and recognizing that the rural communities, women and farmers do need injection of external credit, because if you look at the rural economy, it is credit starved. If you look at the credit to deposit ratio across different states in India, you will find that in more developed states, whether it is Gujarat or Karnataka, the credit to deposit ratio is over 100%, which means that for every 100 rupees saved by the people over there, they are getting credit more than 100. On the other hand, in the least developed states in the country, where you look at Jharkhand, Bihar, Orissa, you'll find the credit to deposit ratio is often like 30%, 40%, 50%, which means that for every 100 rupees saved by the people, actually they're getting less than half of it back as credit. So those areas are credit starved, and hence there is a need for microcredit. Now, with that purpose, microcredit microfinance movement started, and we also started working on linking these self-help groups and microcredit, microfinance institutions to mainstream sources of capital. And when those partnerships started happening, we were actually very happy that finally the mainstream credit is finding a way to meet the needs of low-income people, women, and farmers in the less developed regions of the country. And we saw that, and we believe that it will help people move out of poverty. That's your fundamental question. Subsequently, and this is not like anything recent, as far back as like 2008, 2009, 10, there have already been studies which indicated that microcredit is a good tool which helps people manage their cash flows. It helps some of them start new enterprises, new economic activities, but microfinance by itself is not sufficient to lift people out of poverty. So a number of rigorous research has established that. So it was important to recognize that limitation of microcredit, microfinance. For getting out of poverty, people do need access to a much wider range of services other than credit itself. So if you're thinking about a farmer or a rural women entrepreneur, besides credit, they also need things like cash flow management, banking services, payment services. They also need digital and financial literacy so that they can take advantage of the various schemes and policies that the government has set up to benefit them. And most importantly, they need the skills to set up and manage and run enterprises successfully, and they need access to markets. Unfortunately, microfinance institutions are not equipped, not geared to provide all of this. And also, you cannot load all of this agenda onto microfinance institutions. They're not government. So if you look at them as a business organization, which is delivering one service, which is microfinance, and they're doing it well, to say that they are not lifting people out of poverty is kind of asking a little bit too much. Now, it is not to question the need for such services in order to lift people out of poverty. People do need those services. The question is, who can and who should provide all of that to low-income people? Your other part of your question was, how are microcredit, microfinance institutions different from money lenders? Yes, they are. They are very, very different. In case of money lenders, you and I know it. They will never write off a loan if a client fails to repay. They will find a way to recover that. Microfinance institutions, and particularly after being regulated by RBI, over last 10, 15 years, whenever there's a microfinance crisis for one reason or the other, they would write off loans, right? They would write off because it cannot be recovered, and they will not go and use illegal practices and means to recover money. So that's one. Secondly, microfinance institutions, what they will also do is they will form things like joint liability groups or self-help groups, and use these groups as a mechanism to provide that another layer of safety and preparation for the clients. So that's another way microfinance institutions are different from money lenders. Thirdly, in terms of the client base that they serve, so money lenders will not give loan to anybody and everybody, and sometimes they will if you just give them some kind of a collateral, like pawn your gold with them, or give them your land title. So in case of microfinance, if you see that the current outreach of almost 6.6 crore unique borrowers as of 2024, then they are really serving a much deeper, much larger segment of population. So in that sense, I disagree that microfinance institutions can be treated as same as money lenders. They are different. They are serving larger population, and they are under regulation in many ways, much better regulated. But yes, I mean there are challenges that you cannot really impose all the developmental agenda onto these microfinance institutions only. Let me pause here.
I'm criticizing microfinance from the perspective that a huge social kind of, it is glorified. If it is a business, regular business, I have nothing to say, because the private money lender was purely doing business. He also has very high recovery rates, and he didn't have the institutional support. There was no World Bank to support a private money lender. Yes, there was no RBI in the back in those days when the private money lender was operating. And I believe by glorifying MFIs, we have actually de-glorified. In China, I saw that it is not bank credit, but it is the interpersonal, community credit, which keeps the production up. I mean, I'm looking at playing from the lens of business, I'm not going to add any social value to things. I mean, doing some social work is something different, and doing business is different. So let me go to the second question. It is set on this respect. In India, the current repo rate is 6.25%. So it means that the cost of funds should be lower. The highest, let us take the highest FD fixed deposit rate in SBI and ICICI Bank, which is around 7.25%. Now, from here, at every layer, the spread doubles. From the average borrowing rate of microfinance institutions from banks is plus minus 12%. Microfinance is lending this at 24%. So a 12% spread between the cost of fund and the final lending. Now, I know the traditional arguments of high cost of distribution of credit. The question is arising because you yourself is saying, and I also said in the beginning, that there is a huge credit gap. So the demand is far higher than the supply. Now that is a benchmark of business because the demand and supply gap determines the price. So from there, I'm questioning that why the cost of distribution must be so high. And that too, in the days when you can digitally track every borrower. I mean, assume a hawker, you just geotag his hawking cart and you know exactly where he is. A far more granular level. Why should you add so many layers in the days of UPI? 80% of small retail sales in Kolkata, I personally checked, and 30 to 40% in villages are now done. I'm talking about West Bengal. In some states, it's far higher. Are now done through UPI. Now, I have not come across, I'll like to know from you whether you have seen banks offering cheap microcredit, linking UPI transactions, meaning suppose I have a shop and I take UPI transactions, so I have my revenue statement ready for say 3 years. Now banks will give me loan at low rate. This is the credit rating that they should have done. So overall, where is the effort to deliver credit at low cost? On the contrary, this is an interesting input. If you look at banks which have MFI arm, like Bandhan or Jana Small Finance Bank, I just picked them up randomly. Their FD rates are 0.7 to 1% higher than the regular banks, like, as I said, SBI or ICICI. So what does it mean? Is poor a cash cow to the financial sector? Over to you.
Thank you. And you have really brought out some really critical aspects where the microfinance industry really needs to reflect. And there are a few things, and it's not just for microfinance industry, but also there's a role of regulation here, and I'll come to that aspect a little later. So way back in 2005, 6, 7, 8, the interest rates were really high, hovering at 36%, 40%, which led to a big crisis in Andhra Pradesh at that time, which led to establishing Maligram Committee, which came up with certain recommendations to regulate the microfinance interest rates and to keep it with a maximum spread of 10 to 12%. That report came in 2011. And so RBI said that based on Maligram Committee, that over and above your cost of funds, you have between 10 to maximum 12% margin for meeting all of your operating costs, making a small amount of profit, to manage your write-offs and everything. Initially, microfinance institutions did not like the idea. They said that it's unviable, but very soon they figured out that it's actually very profitable at 10% spread. And as a result, after 2013-14, and especially after we have seen a digitalization sweeping our country, it has become really profitable. Microfinance industry was so profitable that you saw the private equity and venture capital and debt and equity investors kind of pouring money onto microfinance institutions, really pouring money. They were not doing it for charity. They were doing it because it was profitable with that interest rate cap, right? And it's easy to see that now when you have this Aadhaar-based authentication system, which does your remote client verification, eKYC, as you call it, know your customer, you have credit bureaus where every single loans made by NBFCs and MFIs are reported, linked to a unique customer. So all of this data-enabled information systems and digital platforms makes the client identification, client onboarding, and all the transaction flows so efficient, real time, predictable in many cases, and much lower operating cost. So in theory, it should lead to lower operating costs for the microfinance institutions. It should also lead to better portfolio quality and lesser write-offs at the microfinance institutions, and resulting in lower cost of credit to the end borrower. That, unfortunately, we have not seen happening. So as long as RBI allowed 10 to 12% margin over cost of funds as per Maliam committee, MFIs complied with that. Unfortunately, in 2021, for some reason, which I don't understand, RBI removed that interest rate cap and deregulated it and said that MFIs can lend based upon their cost of funds and whatever. So that cap was removed. And suddenly we saw the interest rates spiking up. So MFIs started saying, okay, now there's no regulation, not interest rates are not regulated. So interest rates actually went up. And when there's a mismatch, when there's a gap between credit supply and demand is much, much, much bigger than the supply. Of course, microfinance institutions, when they are free to charge any rate that they feel makes sense, they would charge, because there is a client willing to borrow at more than 24% also. There's somebody who's willing to borrow at 26%, at 30%. So that's what started happening, which is unfortunate, because when the cost of operations are so much lower, thanks to all of the digital platforms and digital public infrastructure that India has set up, which is like state of the art and best in class in the world, we are not seeing these really translating into improved business practices and business processes, which the MFIs can follow and pass on the resulting efficiency and benefits to the end borrowers. That is unfortunate. Now, second aspect you mentioned was with regard to need for multiple layers. And so, yes, now theoretically and technologically, not just theoretically, technologically, it is possible to have what you would call as a...
I'm just interjecting here. You see, when I say layers, you please remember the argument that we give forward in the case of agriculture.
Yeah.
That from the farm gate, the price of agri-produce increases by 3 times, and because of the intermediaries. So the same logic is applying here. And that's it. Over to you.
Yeah. So as I was mentioning, and thanks for bringing that analogy to the farming produce. We have to recognize that intermediaries also play an important role in bringing that produce to the market in terms of aggregation and a lot of other functions. And of course, it does not justify a three times kind of margin that they take in between the consumer prices and producer prices. Coming to microfinance, today, thanks to the technological advancements and platforms, it is actually possible to do away with those layers, right? It is possible to actually set up a neobank, a virtual bank, whereby the customer would only interact with a mobile app on his or her mobile and would never need to visit a bank branch. You don't need bank branches anymore, because everything is possible to be done using technology. which
I
should
have not
actually
visited my branch for at least last 1.5 years.
Yeah. So, and that should significantly bring down the cost of operations for microfinance institutions if they followed that model. Unfortunately, we have seen some of that kind of model emerging more, not so much in India, like virtual credit. Now, in fact, there is a digital credit happening in India also, but a lot of that experience in other countries like in Africa, like Kenya. And consistently, two things have happened as a result of that. One, the cost of such digital credit is actually even more than money lenders, even more than what the MFIs charge. I have seen these digital loans going at 72%, 120% rate of interest. Can you believe it? Number one. Number two, because of all of that access to information, credit bureau and customer identification, the default rates would be much lower. That's not true. Unfortunately, in all those digital loans, the default rates are much higher. Portfolio quality is a real
That is in Africa, you are saying.
even in India, all the digital
Okay.
loans that are being made, portfolio qualities are terrible. So there's something to be learned out there that when you make credit available easily without questioning the person, okay, what will you do with this money? And not tracking the end use of credit, there's a tendency for people to go for credit without realizing that how high the cost of that credit is and without recognizing that I have to repay it at the end of the day. So easy credit actually, when you make it too easily available and do not question, do not monitor the end use of credit, becomes a problem. It's not, even though there's a credit demand and supply mismatch, there's a gap, you should not make credit available too easily. It is to be handled with responsibility. And when the lender is providing that credit, they should make the clients realize their duties and obligations. And that does require some interaction. And that interaction, unfortunately, is not possible completely digitally. So that does bring the need for people who will impart financial literacy, digital literacy, and all of that. So that is another part of it that uh, this layers add to the cost, but also there are certain functions that they can do in terms of screening and monitoring end use of credit. Unfortunately, MFIs are not really doing monitoring end use of credit. One more aspect I'll bring out, which is you talked about enterprises. All of them are receiving their payments from customers digitally. All of them have this track record that they can show to a bank. Why can't the banks leverage that to extend cheaper credit and accessible credit to them? Unfortunately, there's a difference between how you would evaluate the financials of an enterprise versus that of a personal loan. In a personal loan, you are not looking at the person's business and its profitability and all of that. Now, appraisal of an enterprise loan, project financing kind of thing requires a different kind of skill set. Unfortunately, in our banking sector, in the NBFCs, we do not have that skill set, a lot. So a lot of this credit appraisal is actually not happening based upon the performance of your business, but is based upon evaluation of the person, based upon the individual credit score, which is a fallacy. So as a result, the micro and small enterprise segment remains credit starved, not because they don't need credit, not because they can't manage credit, but because you lack that capacity in our lenders to do a good appraisal and offer them credit and how they need. You also gave an example of the banks and NBFCs lending to farmer producer organizations at between 16 to 24%. That's true. But in many cases, FPCs will not even avail that credit.
You said about MFIs, took advantage of the removal of the cap. So clearly, you answered my question that there is no reason to glorify MFI activity for social cause, lifting out of poverty and etc. etc. It is the business, and someone is doing business. Business is done for profits. Period. Let us end it there. You answered my question on UPIs. Why can't it be done? It is very simple. The layman's logic is, if I am a salaried person, I get loans very easily. They take my salary, they take my income tax returns, and they give me loans, assuming that they will get their EMIs. So while the shop owner, whose earnings are linked to UPI, is generating 80-90% of earnings from UPI with written, granular revenue statement. So it should have been done that he should get the enterprise credit for promoting his business at a cheaper rate. But you're right, they are giving them personal credits at personal loans and at high rates. So finally, we are back to the same logic. I fail to understand, if I cannot survive a 20-22% credit card rate or whatever, how can someone survive at that rate? It is, I mean, it's a fallacy. It's a serious fallacy. And if someone is charging 100% rate for digital finance, well, sorry, he lent that for default. Because you may remember back in around during the last boom time, I mean, there is a distinction between these two arguments, giving loans to everyone. If you may remember around 2007 or so, many private banks almost were standing, it was same like the subprime crisis, right? So people were standing on the footpath and in front of the bank branches and almost to grab every other passerby and give him a loan, right? And I'm sure most of that ended up in defaults. Okay. So doing the right scrutiny and giving loans at lower cost are two different things. If you fail on your scrutiny, it's your problem. But you have to give loan at a lower cost because you cannot financial sector. If it is regulated, then where is the regulation? What is the meaning of regulation? Regulation means there is no scope of unlimited profit or abnormal profits. So where is that? We are not saying that MFIs are doing abnormal profit, but we are saying that the question is there. And I'm not only blaming MFIs, I'm blaming the banks also. If your cost of fund is 7%, highest FD rate that I'm taking off, you are lending it at 12%. So why there is a 5% spread between your cost of fund and they? So everyone is, I mean, apparently anyone can say that the people are profiteering. I am taking you here to the question that you started touching upon. See, microcredit is a much bigger set, but we fail to serve the smaller base of small, medium business activities. Every government comes and promises to, offer easy credit to MSMEs, and Modi government is also trying. They brought out schemes. But when we look at the market, if the high interest rate of NBFCs is a clear benchmark that of the demand supply gap. Now, that being said, we have ready examples from the FPOs where huge amounts of money, hundreds of crores were spent in offering them processing equipment at 80 to 100% capital subsidy. But the equipment is idling. I'm told by some agencies that the equipment is largely idling in the absence of working capital. Big banks are simply not interested to deal with small borrowers. They either want some intermediaries or they give loans to a few large borrowers to finish off their quota. And then the lending methods, you're asking an APO, which is a farmers organization with limited equal stake of every farmer to give collateral. That's too much. And if you say that just because they are not giving collateral, so the rates will be higher, that's also too much. The poor fellows are trying to just aggregate their produce and get some extra money out of it. So I'm asking you here, as you have seen finance from the perspective of people. Often we use these words like people-centric policies and all this nonsense. So is it time that we have a clear, let us restructuring the banking sector. Let us have some wholesale bankers, investment bankers like stuff. They will deal with this big. Then there should be retail bankers. And no more of these layers of small banks, these banks, payment banks, and so many layers. So do you think that this is the way out to make our things simpler and more accountable?
There's a lot of aspects here. Microfinance, microcredit movement started by the innovations that nonprofits and social impact focused organizations kind of started doing. And then it kind of became commercial and commercialized. And that's how the banking sector got into this whole thing. So there is room for different kind of business models and entities. And you talked about small finance banks, payment banks, etc. And we also know that some of them are struggling with getting their business model right. For example, in case of payments banks, they've been really struggling with getting their payments business model right. In case of small finance banks, they do suffer from the limitations imposed on them in terms of size of credit and size of not and size of deposits that they can take. And also, in a digital world, every organization has to be digitally savvy and digitally enabled. And unfortunately, investing in those digital platforms costs a lot of money to set up those digital capabilities with regard to platform, customer acquisition, and all the systems and all of that. So, which means that in the digital world, it's very difficult for the small players to survive. Now, that's a important thing to while we're saying we do need different kinds of institutions to bring in innovative business models, and yet in a digital world, it's the network effect takes place, and you need to make those big investments, and hence it's difficult for the small players to survive. You also talked about the FPOs, where the government has invested thousands of crores to provide them capacity building support and subsidies for setting up processing equipment and all of that, which is remaining idle for want of working capital. So why can't government also provide them working capital through organizations like NABARD and NAB Kisan, which are doing it in a small way, but not adequate? Because for commercial banks or for NBFCs, if they're lending at 18% or 20% to FPO, that is unviable for FPOs, number one. Number two, the kind of loan product that the FPOs will actually require, banks and NBFCs are not really able to provide that kind of loan because they are mostly into the business of procuring commodities produced by their farmers and selling it, where you need a working capital cycle of 15 days a month. But the solution that you're offering them is like a term loan to be repaid over 1 year, 2 year at a high interest rate. It's unviable because your capital will remain idle for a long period of time when you're not actually doing the trading. So it's a mismatch between the kind of loan that FPOs will be comfortable with, would really need, and what the banking system is able to provide. So as I alluded to earlier, that we really do not have strong project finance, business appraisal, and product design capability in the banking system, which can design as per what the customer needs, and that's where the problem comes from. So yeah, I mean, briefly, I thought I'll as allude to that aspect. I don't know if you have answered your question.
But I feel that this whole banking structure that we have created is unfit to lend to small fellow. They just don't have the capacity, bandwidth, DNA, nothing. You created NABARD not for lending to the farmers. You created SBI, the fellow who is lending to big infrastructure projects worth over billions of dollars. He's definitely not the person whom you should blame for not giving some 20,000 rupees loan or 50,000 rupees loan or loan to a small businessman, the mom and pop stores. But for the small businessman, for the economy, that small fellow is very important, whether it is income generation, whether it is, he is the MSMEs are the backbone to manufacturing. If you don't have MSMEs, how can you produce?
Organizations like NABARD and SIDBI were set up as a wholesale entities to provide that kind of lending to, in case of SIDBI, to organizations or banks or other entities which will lend to micro and small and medium enterprise. In case of NABARD, to cooperatives and other organizations working with farmers and for rural development. And then you see that SIDBI wants to get into retail lending. NABARD has set up its own subsidiaries, NAB Kisan and NAB Samriddhi and other organizations to get into retail. And they're doing it, but at pretty small scale. And India is a vast country. You do need, you can't really have, one SBI and one NABARD and one SIDBI kind of serving the entire country. You need many more organizations, and need not only be government. Of course, being a government promoted entity comes with its advantage that you get access to softer capital grant or capital investment by the government. But private sector entities can do it. What we need is really when microfinance institutions, which at least have shown that they can reach a vast number of people in the remote rural areas, but for their access to capital, they ultimately depend on either the banks or investors, of course, look for high rate of return. Unfortunately, the banks also are charging pretty high rate of interest, as you yourself pointed out, that the repo rate is 6%, but the banks are lending to MFIs at not less than 12%. So why, banks should charge that high rate of interest? And it's true of not just the private sector banks, but also public sector banks. So yeah, we do have over a period of time established good access mechanisms, which is evident in the form of 6.6 crore unique borrowers being served through 12.3 crore loan accounts. But we have problems with regard to financial and digital literacy, understanding the responsibility with which credit should be delivered and should be used, monitoring the end users of credit. We have really weak project appraisal, project finance, MSME finance, enterprise finance capabilities in our banking sector, in our NBFC sector. So that's where we really need to up our game. And thanks to everything that is possible in a digital ecosystem today, all of that should be possible. It is not that difficult to
Let me,
see the cash flows of a farmer or that of an FPO or a small enterprise, and to design a financing package which will work.
this is the last question. You said you touched upon the role of the regulator. And this is the very crucial part of the story, because how you design a product, finally, it is all about your structure, your designs. It is the regulator that gives the framework for product designing, on which the players innovate. So I have a simple and straight question. Why cannot we fix? We know that it is the microcredit, or it is the credit to MSMEs, that is the biggest thing to the economy. Why cannot we fix a repo plus ceiling for final delivery of loans? Over to you.
It's difficult for me to comment on that question as to whether the interest rate should be fixed at every level by the regulator. The regulator does fix the repo rate and reverse repo
I am
rate.
saying a ceiling. Suppose repo is 6%. So you put up a ceiling of 6 plus 10% for the final delivery. Now, if someone gives it at 12%, let him win the market.
Well, in a market economy and in a globalized economy, we have seen the reduction of regulation incrementally when it comes to ceiling on setting, government deciding or regulator deciding on the ceiling kind of stuff. Often they will decide on the floor so that there is you don't have practices of which do not promote competition. But having said that, I think I would say that there's a much bigger role for policy to play here than regulation, right? For regulator, the job is to see that the financial sector and system is run in a sound and orderly manner and risks are managed. Now, if you look at, let's say, the defaults happening in the banking industry, the number of defaults by small borrowers may seem like lakhs and crores of borrowers maybe are defaulting, but the total impact of that in banking sector is minuscule compared to the total default by all the big players that we have and all the NPS that we have in the banking system. So I think when it comes to access to credit for the MSMEs, and they really need much better access to credit, there's a much bigger role for policy to play here. Where are the gaps? How can we fix that? Whether it is not just MSME, but also agriculture sector. And I think things like more investment in designing better products, more investment in linking farmers to markets, getting them better access, investing in supply chains and logistics, and processing activities in case of agricultural produce and commodities, so that you reduce the wastage and all of that is required. Much bigger role for policy, I would say, than regulation here. Because regulation, we have seen flip-flops happening, as I alluded to. 2011, we have Maligram Committee setting up interest rate regulation. 2021, RBI saying that interest rate deregulate. We don't know what influences these actions and decisions and how it may pan out in the future.
Thanks, Prabhat. Yeah, for the audience, it was very, I should say, it was prized to get Prabhat, because this is a subject he has lent out to microfinance institutions. He has been associated with some of the most glorified, like Grameen Foundation, microcredit activities. And I wanted, it is not a criticism of, we all are, actually we are stressing upon the microcredit. But what the issue is that there should be a competition to reduce costs, which we are missing out. I think that is what at least I'm missing out. I don't see that competition to reduce costs. Ideally, in a liberalized economy, there should be competition to reduce costs and improve efficiencies. So when the costs are not reducing, I will question the efficiency level in this intermediaries. I'll also question whether they are using this lending much maligned. They show little respect. I mean, I'm talking about from the point of view of banks. They show little respect to these small borrowers. But in the end, there is a scope to think that they are extracting the best of the margins from the small borrowers or the loans dedicated to small borrowers. So thank you, Prabhat, thanks for giving your time.
Thank you so much, Pratim. It was wonderful to speak to you and to talk about this topic, which is always very close to my heart. And of course, I also feel dissatisfied, dismayed by all the things that we see around us, which is not always the best. And hence my effort is to really how we can improve the lot of low-income people, women, farmers, micro and small enterprises. In my own way, I'm trying to do that in my new venture now, which is hoping to connect the farmers to markets so they can get better access to, because those are kind of ways to increase their incomes. And likewise for micro and small enterprise segments. So yeah, I mean, we have really touched upon some very, very important points here. And also just one small last remark I'll make, which is that regulation, like we saw in Nachiket Moore committee recommendations, that you have to assess and evaluate the suitability and repayment capacity of the borrowers. Now, it's easy to say that. It's difficult to put that into practice. Even today, the RBI regulations do require MFIs and NBFCs to assess that aspect. But in practice, how it is done leaves a lot to be desired because it's not easy. So I think there are challenges in terms of putting to practice the regulations and rules and all of that. So yeah, there's a huge capacity issue, and there's a herd mentality. People are not really innovating. Everybody copies the other one and try to just do it without improving upon things. There's lesser focus on impact, more focus on commercial returns and profitability driven by, of course, their investors. So all of those problems are there. Government can step in through its access to capital that it has, and it can potentially pump in through institutions like NABARD and SIDBI and others. But I think that needs to happen at a much bigger scale. Government needs to play a much bigger role in terms of supporting these good practices to evolve. Thank you.
Thank you so much.